Beneath the ebb and flow of monthly data, there are two big problems facing China's economy: debt and overcapacity. Joining us to discuss how these two things link together is Francis Cheung, Head of China Strategy at CLSA. Thanks for joining us, Francis. You've brought along some charts. Let's have a look at the first one, which shows us how the overcapacity problem and the debt problem are both getting worse simultaneously.
This is one of the most important charts I can show investors to help to understand China, especially now with the third planet coming up. Well, what this chart shows is two things: that one, debt to GDP has been rising. The most interesting thing about this chart is the inflection point. From 2002 to 2008, you see debt to GDP has been flat, then suddenly starts to rise. Now, with the benefit of hindsight, we understand that in 2002 to 2008, actually there was some leverage driving it up, but it wasn't leverage in China. It was some leverage in the rest of the world, which actually gave China a lot of growth. When the world started deleveraging with the global financial crisis, China didn't really understood that. They kept setting these high growth targets, and as a result, they had to incur debt. They had to leverage up themselves, get the high GDP growth. And one of the troubling things is, in March of this year, Hu Jintao set the economy on a 7% growth path through 2020. So the new leadership has a challenge to try to figure out what is the right sustainable growth rate without adding a lot of debt.
I mean, so this comes back to the stimulus of 08, 09. That was supposed to be about infrastructure and affordable housing and things like that. So was it not? Was it about making more steel?
I think this is the problem. There was actually a policy mishap, right? Clearly the stimulus should have been focused mostly on infrastructure, maybe 70 or 80%. You look at what actually happened since 08 to 2012, half of all spending was on industrial capacity, only about 24% was in infrastructure. Here's the problem, right? They're building a lot of capacity at a point in time when global demand was weakening. Now you have an excess capacity problem. We're worried that excess capacity will get worse from here. In a couple of years' time, we think you could reach a critical level where the entire industrial complex in China would look sort of like the steel industry, which you all know is in a lot of trouble.
I mean, in terms of how this relates to the broader economy, if we move on to the next chart, has investment-led growth worked? Is it working, and will it continue to work?
What we try to show in the next chart is this very simple ratio, it's capital output ratio. And the way to read the ratio is the lower the ratio, the better it is. It takes less capital to drive growth, and the higher the ratio it is, the worse it is. So what you see from, let's say, from 1979 to 1995, the ratio actually was coming down. And that's mainly due to all the reforms that China was doing, and the capital that was employed was very productive. So you didn't need a lot of capital to drive growth. But since the global financial crisis, that's been rising. And I believe it's going to continue to rise because it takes more and more capital to drive growth.
And looking forward, is there any signs that these trends might be reversed, that these problems might get easier?
I'm afraid that this will be a tough one. Because right now, what's happening right now is that they're still setting 7% GDP growth in the next few years. Now, to achieve that 7% GDP growth, I think you're going to have to incrementally add more debt and more investments. And unless they find a much more productive way to invest, the excess capacity problem is going to get worse.
The third chart that you brought along, it has your projections going forward about the capacity utilization. That doesn't look very positive.
If you look at the industrial investment right now, it's running around 17%. And your industrial output is running around 10%. So your capex or your investments is rising faster than your revenues. So it's just the economics of the number. If your investment keeps rising faster than the revenue you're generating, your capacity utilization will get worse. Especially you keep doing the same thing you've been doing the last few years.
I mean, just finally, if we think about what this means for investors, the A-share market in Shanghai and the H-share market here in Hong Kong, they both have a large industrial element to them, the index, and they have a large banking element as well. So if we think these problems are going to get worse, what does that mean for investors?
Generally, the stock market don't like slowing growth. And if we can the government can manage the growth to be nice and gradual and slow down, then you have more visibility and you can price that in. So there are very good investment opportunities, but overall the index may be stuck for a while.
And is there any good news?
The good news is they understand the problem, right? That's one thing good about China. They're very good at analyzing the problem. The question is there enough crisis? Do they feel the urgency enough to push for change? And we should know in a few weeks' time.
Francis, thank you very much for joining us.
Great.
And you can read plenty more on this at ft.com/China.